There's so many things happening right now. World trade is shrinking, and that almost never happens except in recessions or, during the Great Depression. The recession indicators have been signaling a recession for a long time. The long term, when I say long term, I mean the ones that have the best track record of being good predictors further in advance. So a lot of economists, and I would include myself, have said, there was going to be a recession in 2023. According to the data, that didn't happen. But it doesn't mean that the warnings were wrong. It doesn't mean that we won't have a recession. It just means that it has taken longer to unfold than a lot of people expected. But now those same signs are actually getting worse. Unemployment report that came out about a week ago was completely misread. I mean, that was, the stock market went up, job creation exceeded expectations, unemployment remained constant. That was consistent with the happy talk, with the Goldilocks narrative, soft landing narrative, et cetera. And so kind of stocks rallied on that. But if you look behind the numbers, and there are two surveys, one of them showed about 220,000 jobs created. The other one showed 1.5 million full-time jobs lost. And then there were about 700,000, a little more, part-time jobs created. So if you net the two, you still lost 750,000 full-time jobs. And then, of course, part-time jobs aren't nearly as rewarding as full-time jobs. Hourly wages went up, okay, but there were fewer hours worked. That's how employers are managing the costs. Like, I'll pay you a little more, but you work 30 hours instead of 40, so you're making less money. So, and then they gave a downward revision to the prior months. And for 12 months in a row, 11 out of the 12 months, they have downwardly revised the prior month's number. When you're like 11 out of 12 months, that's not random. There's a certain amount of noise in the data. Everybody understands that. But that's something seriously flawed in the model. You don't get that rolling the dice, getting a 6, 11 times in a row. It doesn't happen, or it's extremely rare. So there's something wrong with the model. So there's a lot less there than meets the eye. We have so far, but I think our luck has run out, if you want to put it that way. Germany's in recession. They just are. That data is clear, and it's getting worse. Japan is kind of right on the edge, might be in recession. UK, same thing, right on the edge. China, saying China's in recession is probably a stretch, but in China, if the growth goes from 10% to 7% to 5% to 4%, which it has over the last 10 years, that lost output is equivalent to a recession. China's trying to prop up their economy, so their economy is doing very poorly. When I see things like world trade contracting, with the trade figures, everyone focuses on surplus or deficit. So you have a trade surplus, your GDP goes up. You have a trade deficit, your GDP goes down. Or did the deficit shrink? That makes GDP a little higher, et cetera. Forget about that. I mean, it's important data. But if you look at the top line, the exports and the imports, they're both shrinking. So whether the deficit gets a little bigger or a little smaller is less compelling, less important than the fact that both numbers are going down. World trade is shrinking. And that almost never happens except in recessions or, during the Great Depression. The Fed, of course, always says we're not political. We do what we're supposed to do. We follow the models. We're not political at all. That's completely untrue. They're highly political. They watch the headlines very closely. So they're aware of it. And you have to sort of put Jay Powell in context. He is a Republican, but he's a Bush Republican. There's no reason to think he likes Donald Trump or is a Trump supporter, et cetera. He's not a Democrat, but he's the kind of Republican who doesn't really like Donald Trump. My expectation is the Fed, for now, is not going to cut interest rates. They're done raising. That's pretty clear. You'd have to have some kind of inflation shock before they raise rates. That is unlikely to happen. Prices are going down. The rate of inflation is going down. Prices are still going up. That's a big point of confusion. So prices are going up, but the rate of increase has dropped from 9% to 3% in the past 16 months. So that's progress. 3% is still well above the Fed's target of 2%, but they think they're at what they call the terminal rate. The terminal rate is the rate where it's high enough to bring inflation down without having to raise rates more. In other words, it's high enough to act as a brake. Just give it time, and inflation will come down on its own without further rate hikes. The Fed believes they're in that position and they won't be raising rates. So the question is, when will they cut rates? The answer is when it's too late, meaning the Fed are usually the last to know. And the best example I can give it, they pay enormous attention to what we just talked about, the unemployment rate. 3.7%. That's one of the lowest unemployment rates since the 1960s. I mean, it is extremely low. But they believe in this Phillips curve, and the Phillips curve is an inverse relationship between inflation and unemployment. So the view is if unemployment is low, inflation is going to go higher. If unemployment goes up, inflation goes down. So they're saying unemployment extremely low and saying, well, that's a little bit of a danger in terms of inflation, so we can't cut rates. But in fact, there are a lot of problems with that. First of all, there's no evidence for the Phillips curve. I mean, I can show you high unemployment, high inflation in the late 1970s, I can show you low unemployment, low inflation, in the mid 2010s and so forth. So you can find every low unemployment and low inflation during the Great Depression. So there is no Phillips curve. First of all, the Phillips curve is garbage. Secondly, employment is a lagging indicator. I'm not saying it's an unimportant number, but employers do everything possible to avoid laying people off. When revenues are drying up and margins are going down and profits are going down, they'll turn out the lights. They'll renegotiate the lease. They'll cut the laundry bill. They'll bargain harder with suppliers. They'll do everything they can except fire people, because people are hard to hire. You get the talent, it's hard to find. You train it, the last thing you want to do is fire them. So they will fire them. Unemployment will go up when they get desperate enough. But by then, the recession has already started. In other words, it's a lagging indicator that tells you nothing. So my point being, Jay Powell is looking at lagging indicators. If unemployment starts to go up, which I expect it will, he will cut rates, but we will already be in the recession. So he'll have political insurance, because they'll say, yeah, we're cutting rates, but hey, we're in a recession, we have to. They'll be in the political crossfire, but the economy will be so bad at that point, no one's going to blame Jay Powell. Let's go back just to the years before the war in Ukraine. So it started at the end of February 2022. Well, for 30, 40 years since the end of the Cold War or longer, the Russian central bank had held a portion of their reserves in U.S. Treasury securities, dollar denominated, but U.S. Treasury securities in particular of different maturities, bills, notes, probably some bonds, mostly shorter term bills and notes. To their credit, Elvira Nabiullina, who's the head of the central bank of Russia, in my view, she's the only central banker in the world who knows what she's doing. She put 25% of Russia's reserves in physical gold held in custody in Russia, in Moscow. So the point being, you can't freeze gold. I've always liked that about gold. It's not digital, it's not electronic, you can't freeze it. You can say what you want. So that part is off limits. And they had some other types of investments. A big chunk of it, about $300 billion, which was about half their reserve position. Their reserves were about $600 billion. They had $150 billion in gold. The last paper treasury security was issued like in 1979. They're all digital. They're all called the dollar, the original cryptocurrency, but they're held in custody, mostly in Belgium, but other European banks as well, other custodians, Deutsche Bank, UBS, and some in the United States, but mostly in Europe. Now, on day one of the war, within a matter of days, those treasuries were frozen. But let's define what frozen means. Frozen means you, Russia, you still own them, but you can't have them. You can't collect the interest. You can't sell them. You can't trade them. They're yours, but we're locking them up. And the U.S. Treasury and the Fed control the ledger, so they can enforce that. They can make sure that those securities cannot be transferred. That's freezing. Now what they're talking about seizing them. Seizing is different. That's when you steal them. That's when you take them and say, hey, Russia, these are not just frozen, they're ours. We're taking them. They're not yours anymore. And selling them at the market and using the $300 billion of proceeds to finance the war in Ukraine. Not only are we taking your money, but we're using it to finance your adversary in a war. Now, a little background, as of now, there is no money for Ukraine. So where do you get the money? Well, maybe they can figure this out. But all of a sudden, Johnson and the White House say, hey, we got $300 billion sitting right here in the banks. Let's just take it and spend it on Ukraine. If you do that, you will destroy the U.S. Treasury market. I've been talking about it. Others have been talking about it. Maybe somebody will tap on the shoulder and say, hey, Mr. Speaker, do you understand what you're doing here? But Janet Yellen, who's sort of, not that bright, kind of does what she's told. She's going along with the White House view of this. They just think it's free money. They don't understand the implications. What country in the world would want to own a Treasury security, $1 worth, if you think the U.S. will take it if they don't like what you're doing? There's a lot of weight to the BRICS. And by the way, the BRICS is not a political union. It is an economic union with a focus on trade and currency. Yeah, China and India, they fought in the Himalayas. Saudi Arabia and Iran are both members. They've had their differences, et cetera. So to say there are all these political differences among the members and it's not a perfect marriage or whatever, yeah, but that's not the point. Point is they're working on a currency union and a free trade area, and you can have that. India and China can fight over the Himalayas all they want, but if they reduce tariffs and have a common currency, that's a big deal. And as far as, they've been talking about this a long time, they haven't made much progress. That's not true. They've made a lot of progress. They have the New Development Bank, which is basically a clone of the World Bank. They have the Contingent Reserve Arrangement, which is basically a clone of the IMF. They spent a lot of the last 10 years duplicating the Bretton Woods institutions under their own control and for their own purposes. So they sort of cloned Bretton Woods in a way they control. They're building their own communications networks. And here's the big thing. They had the Leaders Summit. I was one of the ones writing and talking about how it would be highly significant in terms of advancing the currency. The new BRICS currency is what we're talking about. Gold linked, by the way. And it sort of came and went, and people said, hey, Jim, nothing happened. Like, you were talking about this, and what was the big deal? Well, there was a very big deal, which was adding the new members. because there's no point. What's the benefit of a bilateral trading currency? If it's India and China, it's easy to invent a currency. Just pick a name and print some, and there you go. But if India and China had a common currency and India's ship goes to China and got paid in that currency, what can India do with the currency? All you can do is buy stuff from China. You might need some stuff from China, but you want to go shopping everywhere else in the world. Same thing with Russia and India. So how do you make a currency union work? Well, the answer is you expand the membership so that when you receive the currency for your exports, you can spend it somewhere else. That's what the euro is. So the key to a successful currency union, you don't need a common fiscal policy. I mean, does anyone think Germany and Greece have the same fiscal policies? You don't need a genuine political union, but you do need agreement on we're going to have a common currency. We'll all be able to trade it among ourselves. The key is expanding the membership so that the currency is worth something because you can spend it in more than one place. Once you get that far and you agree on a central bank, and I said they already set up the National Development Bank in Shanghai, so they've got a bank kind of waiting to go. Here's the way I put it. They don't want to destroy the dollar. They don't have to. They actually kind of want the dollar around to do their dirty work. What they really want to do is free ride on the dollar. A unit of BRICS currency, called one brick. I don't know what they're going to call it, but let's call it a brick. One brick will equal a weight of gold, not a dollar amount. They're not using dollars. It'll be a weight of gold, an ounce, a kilo, I don't know. Now, the weight of gold will have a dollar value based on the dollar gold market, because as you know, the gold market is overwhelmingly dollar based, which means that through a transit of law, A equals B equals C, so A equals C, the BRICS will have a dollar value, but it won't be linked to the dollar. It'll be linked to gold, and then the gold will have a dollar value, and you'll be able to, again, come up with a dollar value for a brick through a transit of law. But meanwhile, the dollar is the one that's got to go out there and hold up its end in the gold market. And so if you're the BRICS and you define your currency by weight of gold, what do you want to happen to the dollar price of gold? You want it to go up, because then your currency goes up.
Makes sense.
Right. So in other words, the dollar's got to do the dirty work in the gold market, and the BRICS can just free ride.
You say investors are relaxed because they believe the banking crisis is over. That's a huge mistake. Tell us why you believe it will come back to haunt us in 2024.
First of all, that's what history shows. And none of these things are completely deterministic, but financial history can be a pretty good guide. And you go back to 1998, 1997, 1998, what happened? Just very briefly, that crisis came to a head in September 1998 with long-term capital management and the Russian default. But it started in Thailand in June 1997, when they closed the capital account and devalued the Thai baht. And that started a panic throughout Asia, because everyone assumed that all these pegs to the dollar were safe and you could put dollars into Thailand and Indonesia and so forth and not have to worry about the exchange rate. And all of a sudden there was a run on the bank. I talked to Dr. Mahathir, who's the Prime Minister of Malaysia, about this. He was the only guy who kind of got it right. But once Thai did that, then there was a sequential collapse, bank run, if you will, in Indonesia, South Korea, Malaysia, etc., throughout Southeast Asia. But then it calmed down in the winter. And it was very serious in the fall. I mean, people were getting killed in the streets in South Korea. But by December 97, January 98, February 98, it had died down. It looked like it was over. And I was at long-term capital management. We weren't worried about it. We were looking at expanding our business in Asia. And we actually paid a $3 billion all-cash dividend in December 97. And that's how confident we were. We gave $3 billion back to our investors. But then by April, it started to hot up again. And then the Russian default was in August and the LTCM meltdown was in September. So that had two stages, but a quiet period in between. Same thing in 2007, 2008, the global financial crisis. That really took off in the spring of 07 with the mortgage losses. And then, we all remember Jim Cramer's, they know nothing.
They know nothing!
But then it died down in the winter, but it came back with Bear Stearns. So these things do have two stages. We're in a quiet stage right now, but I expect the banking crisis will return. When you say it's here to stay, gambling is here to stay. They gambled during the French Revolution and they gambled in 19th century London, and you can go to Las Vegas or Atlantic City today. So gambling is here to stay. It's not a particularly productive activity. It costs people more than they make, but it's a form of entertainment. So I think of Bitcoin as a form of entertainment. I think of Bitcoin as a casino chip. Okay, so you go into a casino, you put $1,000 down on the roulette table, croupier gives you $1,000 worth of chips, you gamble, you could make money or lose money. When you're done, you pick up your chips, you go to the cashier and you get dollars and you go outside. In the world of crypto, you can buy and sell Bitcoin all day long and you can calculate dollar profits. But if you want your profits, you have to sell it, get your dollars out of that world and go back out on the street. But the Bitcoin itself has no value outside the casino. If I walk out of the casino with the chips in my pocket and try to buy a cup of coffee with the chips, you can't do it. I mean, maybe somebody will help you out, but basically you got to convert back to dollars. So Bitcoin are chips in the casino. You can gamble, have fun, kind of entertainment, make money, lose money. Most people lose money, actually. Some people have made it a lot. It's true. Just keep the gold. You have the gold for the day when the dollar's not worth anything. That's why you have the gold. So that's number one. Number two, tell me the use case for Bitcoin. I mean, there is no use case. As a form of speculation, as a form of gambling, yeah, it's the chip in the casino. I'll grant that. People tell me, oh, Jim, you're technophobic. You don't understand. I read Nakamoto's paper in 2009 when it came out. I've been in gold Bitcoin debate since 2010. I never lost, by the way. Yes. So I get it. I get the technology. I get the math. But I also understand monetary economics. And there is no use case for Bitcoin except for entertainment. There are a number of factors that drive the price of gold, and you know them. You start with supply and demand. Supply has been constant. Global mining output hasn't gone up or down very much for about 6 years. It's pretty flat. Demand is going up, not because of retail. Americans don't understand it, but central banks do. And you know, Russia, China, Mexico, Kazakhstan, Vietnam, a long list of central banks have been acquiring gold. By the way, they're acquiring more gold now because this whole treasury bill confiscation we talked about earlier. So when demand is up and supply is flat, that tends to drive prices higher. So that's a good start. But the biggest factor driving gold prices recently is declining interest rates. So if you said, Jim, give me your forecast for gold, I would say, well, let's start with the forecast for interest rates. And the forecast for interest rates is they're going to drop a lot, very steeply. They already have. The yield to maturity on the 10-year note dropped from 5% to 4% in like the blink of an eye. It was like a couple of weeks. It's going to go to 2 or lower because now we're back to the recession. You get the kind of recession and disinflation and even deflation that I see that we're talking about, then interest rates are going to come down a lot, and that's going to send the price of gold a lot higher. It's good to be prepared. By the way, you can make money in downturns. You just have to see it coming. Downturns, you just have to see it coming. Downturns, you just have to see it.
What do you think's coming for stock markets in 2024?
Not a pretty picture, but I think investors really should be prepared for the worst. If you're not getting out of stocks, if you want to be in stocks, I would recommend defense, energy, and mining. But I'd be out of tech, I'd be out of consumers, and I'd increase my cash allocation. I think I can keep this brief in the sense that a lot of what's going to affect the stock market is the geopolitical situation. So we talked about that in depth. But if you got a 401k and you're just buying the S&P 500 index from Vanguard or Fidelity, and it's been going up and it has been going up, there's no question about that. And you're like, I'll just sit there and watch it go up. You know, be careful. We've been warning about a stock market decline for a long time. It's happening. You know, Wall Street's out to sell you stocks and CNBC says, you know, up, up, up. There's nothing I see that's going to make that better. I don't think the Fed's done raising interest rates. I remember the 1970s, the stock market peaked. Dow Jones peaked in 1969. It didn't get back to that peak until 1982. Now, okay, 1982 was the beginning of one of the greatest bull markets in history, grant that, but 69 to 82 is 13 years. It went sideways. Now, again, there's volatility and dips and peaks, and I'm not saying you can't make money, but I'm saying that there's a 13-year period when the stock market ended up where it started, number one, around 1,000 on the Dow. When you adjust for inflation, because we had massive inflation in the late 1970s, it was still down. That's 13 years. That's going to get worse because the U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was up 5%, but it was very heavy on consumption and very heavy on inventories. Well, consumption, obviously, people don't realize when wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you know, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices, they do 2-for-1 sales, they just move the merchandise, and particularly in certain areas, stuff goes out of style. You know, the fashion industry is notorious. You know, who wants last year's coat or whatever. So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumers just hit the brakes. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February of 2021, right after he was sworn in. Here comes another $1,600 check. Then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. We were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that, but that was the deficit alone was about $2 trillion a year. Well, the Americans got used to that. Thanks for the check. And then there was the deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while. But then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 20 to 25%. People are tapped out on the credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another, that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. You won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You know, you can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. And if you do have stocks or some stocks, I wouldn't do the index funds. I would look at energy, defense, not for good reasons. There's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up, I get it, but it looks like they peaked and have turned around. So treasury notes, a good 2-year note, a 5-year note will perform very well, and they're very safe, obviously, and just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, that's not good for stocks. I'm going to start with Ukraine. And the interesting thing about that is, of course, the war started, well, I would say it started in 2008 when George Bush declared that Ukraine should be a member of NATO. That was really the beginning of everything that's happened ever since. The U.S. was spent years kind of provoking this war. But the Russian special military operation started in February 2022. So we're about 2 years into this at this point. And I live in Portsmouth, New Hampshire. I'm here now, and we got our share of conservatives, but it's a pretty liberal town. And there's a section, an older section, where it's like all super liberals. And I remember in the spring of 2022, everybody had Ukraine flags out. They took down their Black Lives Matter banners and put up Ukraine flags everywhere. And I just looked at it. I had an open mind. I don't like to jump to conclusions. And I saw that Ukraine is the most corrupt country in Europe, one of the most corrupt countries in the world. It's an oligarchy. It was a money laundering machine for the Democratic Party. We sent the money and they sent it back, a lot of it in the form of campaign contributions. And a large percentage, maybe half the population are Russian speaking, really consider themselves Russians. And I said, what's so great about Ukraine that the U.S. is supposed to go to the brink of World War III over it? But I kept an open mind. The more we went down that timeline, the more it was clear that Kiev, Ukraine, was just a corrupt skim operation. They'll take all the money we can give them, buy themselves houses in Dubai or Miami or Switzerland or wherever, and fight to the last Ukrainian. 400,000 dead. That's a conservative estimate. The actual number is probably higher. Just on the Ukrainian side, 400,000 dead for what? But everything about the war was misguided. The plan, if there was a plan from the neoconservatives, the warmongers in Washington, the State Department, White House, their plan was, we'll give them the money and the weapons, let them do the fighting. The Russians will come in, we'll bleed the Russians, we'll put sanctions on their economy, crush the ruble, cut off their exports of oil, cut off their revenue, kick them out of the bank message traffic system, kick them out of SWIFT, freeze the assets of the Central Bank of Russia. And not only will the military be depleted, but the Russian state will have economic unrest, will be a popular uprising, they'll overthrow Putin and we'll march into Moscow. That was actually the plan. As ridiculous as that sounds, that's what they were thinking. It was never about Ukraine. It was all about defeating Russia, getting rid of Putin, and kind of running up a NATO flag over Red Square. None of that has happened. Everything about it was wrong and misguided at the time. And I said so at the time. I teach a course in economic warfare at the U.S. Army War College. You said I was a former advisor to the Pentagon. I guess I still am. I do teach this course, and I talk to people in the military on a regular basis. But I said in April 2022 that the sanctions wouldn't work. They would backfire. It would not hurt Russia. It would hurt us more than it hurt them. It would hurt Europe more, etc. And the Russian army they do get off to a slow start, but they finished the job. Anyway, all those things have played out exactly as I said. So they may unleash a complete missile bombardment from southern Lebanon that could hit major Israeli cities, Haifa. I've been to all these areas. If they unleash this, then Israel will certainly fight back. So then you're going to have a two-front war. And this is where the U.S. might get involved, at least with air power. But here's the big question. Does anyone attack Iran? And there's good reason to think that we're at the point where the U.S. and Israel, and obviously the U.K. are in on this. So you know what? All the money, all the training, all the advanced weapons are coming from Iran. Why don't we just take Iran out once and for all? And by the way, they're getting very close to having nuclear weapons. This has been discussed for 15 years. But has the time come to, sink their fleet, destroy their nuclear reactors, destroy their enrichment plants to the extent you can find them, assassinate their scientists, and who knows what else? I'm not saying that's going to happen. Hopefully it doesn't, because it's getting close to World War III, but that could be what happens next through an escalation process. Gaza, Hezbollah, just take out Iran, be done with it. The problem is you can't just take out Iran. I kind of shrug. It's like, well, but then the Russians will come in. And what if the Russians are escorting supply ships to Gaza? Where are we now? I can stop there, but my only point is viewers and investors should not think of this as Israel attacks Hamas for revenge or counterattack or whatever. Yeah, that is going to happen. But this could escalate to something like World War III and nuclear weapons involved very quickly. So let's not forget about that. And China, they're watching the whole show. They're ramming Philippines fishing boats in the South China Sea. Why do we have a war in Ukraine, a war in Israel, and something close to war in the South China Sea and other trouble spots around the world, Syria, Iraq, etc. All of a sudden, it's because 2 years of Biden and nobody's home and they're taking advantage of it. Everybody else in the world says, hey, here's my chance. When we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. Short-term treasuries, 4-month bills, 6-month bills, up to 1 year. From 0 to 1 year, they're called bills. From 2 years to 20 years, they're called notes. And the 30 years called a bond. So if you're an expert, you say bills, notes, and bonds, but they're all treasury securities. So I just want to be specific. We're not talking about corporate bonds, just to be clear, because those pay very poorly. If companies are going to underperform, we're going to go into a recession. You're going to see bankruptcies increase. Those corporate bonds are going to get hammered, but certainly junk bonds. So we're talking about U.S. treasuries. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's kind of goes upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. So the interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's, like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying between 5.25% and 5.5%. Well, yeah, Jim, that sounds good. But if interest rates go up even more, the answer is you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make it lose money, but that inverse relationship kind of throws a lot of people. But yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is if you think the 2-year note is going to go to 6%, you might not like it because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note because a longer maturity. So interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is the longer the maturity, the more they go up. They're more volatile. And so when I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too. The old cliche, which is true, a week is a lifetime in politics. Well, that's true. I hate cliches, but that one happens to be true. A week is a lifetime. A lot changes. And the answer I gave is, well, we're doing this now because the election is happening now. There'll be election day in 2024, a lot of early voting these days. I guess it really starts in September, whatever. But the election is happening now because things are happening that are going to determine what happens by the fall of 2024 in particular. Meanwhile, the world's blowing up. By the way, those two things are not coincidental. Oh, war in Ukraine, war in Israel, something close to war in the South China Sea. Oh, gee, it's too bad we don't have a leader in the Oval Office. They're not unrelated. The world looked at, I call it the Chernenko moment. You have to be a Soviet Union expert, but in the early 80s, they had a president, a general secretary of the Communist Party, leader of the Soviet Union, named Chernenko, who was brain dead. Sorry, I'm overstating. Not brain dead. He'd fall asleep in meetings, couldn't talk. But then he died, and they got another guy, Yuri Andropov, and then he died. And then somebody was like grilling, and then they got Gorbachev, and somebody asked Ronald Reagan, said, why won't you negotiate with the Soviets? He said, they keep dying on me, which was true. But we, obviously the intelligence community, knew that Chernenko was mentally incapable. And it doesn't get better. If you know anything about progressive cognitive decline and the kind of diseases, there are no cures. There are treatments, but there are no cures, and then you die. And the Democrats know it, and they know what's going on. Gavin Newsom met with Xi Jinping, who's the president of China, the head of China, most powerful Chinese leader since Mao Zedong. What does that tell you? It tells you that Beijing knows that Gavin Newsom is the most likely candidate for president of the United States in 2024 on the Democratic side, likely to be the next president. And there's a long history. Foreign leaders, if you're running for president, you're not the president, but you're running for president, you get meetings with foreign leaders. You'll go to Israel, obviously Canada, Japan, China, because they want to know you just in case you win. They don't want you win, you get sworn in. They don't want you to be a stranger. So that's not unusual. But the fact that Xi Jinping takes a meeting in Beijing with Gavin Newsom tells you that the Chinese are saying what I'm saying. I think it's entirely possible. It's not just a guess. I do think it's likely that Trump will be behind bars. Trump will be in a Fulton County, Georgia jail on election day. I still think he's going to be the nominee, and I think he's going to win. So you're going to have this spectacle of Trump with orange hair and an orange jumpsuit, a prison jumpsuit, behind bars in the Fulton County jail, elected the next president of the United States. There's no prohibition on that, by the way. This is not impeachment. There's no prohibition on a convicted felon being elected president of the United States. There just isn't. It's not in the Constitution. They may have to give him a supervised release so he can go to the Oval Office. Trump's going to be convicted of a crime. Now, he's got lots of grounds for appeal. Appellate courts may throw it out. It may get reversed. I understand all that. But he's indicted on 90 felony counts or more in 4 different jurisdictions. But it's important to know that the world economy is slowing down. Germany is in recession. Japan is very close to it. UK, very close to it. Canada, I'm hearing nothing but bad reports, housing market collapse, etc. China may not technically be in recession, but it's slowing rapidly. The thing with China, it's the second largest economy in the world. They've been growing at like 10%, 10% for over 20 years. When you compound something at 10% for 20 years, you're going to increase it by a factor of 10 or so over that time period, but not now. They're almost certainly below 5. They're going to print 5 because they make up the numbers if they have to. But when you strip out wasted investment, investment that you build a massive train station with 128 escalators and marble walls, but nobody goes there and the tickets are $10. You can't pay for that. It doesn't produce any wealth. It just creates jobs. The real estate sector is collapsing. That's been the biggest driver. People are not stepping out to buy houses. They're not taking the bait. Lower interest rates haven't helped. China's in a massive slowdown. Whether it's technically a recession almost doesn't matter, because when an economy that big slows that much, it drags the world down with it. So China's not going to save us. Europe's not going to save us. And this is new. I'm going to throw another wild card here. It's a bit of a stretch to think the U.S. is going to dodge this bullet. If China's going to slowing down, Germany's in recession, Japan's getting close to recession, Canada, UK, emerging markets, the whole world, plus what we're looking at in the Middle East, the idea that the United States is going to boom while the whole world is going down is just not true. Globalization may be yesterday's news, but it's not over. Supply chains are still global. And we're seeing a lot of problems in the U.S. The U.S. has been doing better than the rest of the world. The rest of the world's not doing well at all, and particularly China. And the U.S. is going to follow the world into this global recession.